So you're thinking about getting a mortgage because you want to buy a house, you're not sure where to start, and frankly, the idea of sitting down with a professional like me might be what's holding you back. You're just not sure what to expect, how the conversation is going to go. You don't want to feel stupid. Don't worry, I've been there. I've been doing this for a long time, and I want to help you out. So in this process, what I'm going to do is quite literally walk you through the initial concept, the initial application process that you would have with me at Be My Neighbor Mortgage. And don't worry, it's not going to be one of those like weird ASMR things.
Welcome to the mortgage application ASMR. It's just this easy.
This is actually more of an educational thing by role-playing, by interacting what exactly is going to happen, what I'm going to talk about, how we're going to get into it. So hi, my name is Nathan Nottingham. I'm a loan officer and chief of staff at Be My Neighbor Mortgage. We're a mortgage broker and my NMLS number is 270165. So if you're out there shopping and thinking, I want to get a home, but I just don't know where to start, and you're looking at the homes, right? You go onto all the websites. Maybe you went to realpha.com and you're actually searching out a home using their AI tech, and you're like, wow, I found something that looks really good, something I really would like to have. Maybe this is for me. Maybe it's for us. Maybe we're ready. Well, you can want, but you now have to buy. And frankly, all the data shows Americans don't have the majority, and I mean like 90+% of us don't have the capital to just go out and buy a house with cash. So we have to finance it. That's the mortgage. Now, the history of the mortgage is really not as old as we may think. Somewhere back in the 1917s to 1920s, before the Great Depression, you could get a mortgage, but it was never more than 50% of the price of the home. You had to save up a lot of money, and then you could borrow, and the terms were not really much longer than 10 years. Now, after the Great Depression, right, with the bank collapse, if you remember It's a Wonderful Life, remember they're all going in there because George's bank has fallen. Well, people were calling it due, and those mortgages were actually paid twice a year. You would make a payment in the middle of the year, and then make a payment at the end of the year. But the savings and loan banks, well, if they didn't have enough capital, they would close down and they could take your house back.
No, that's all right. I'm okay. I'm okay.
It's kind of a dangerous way to do it. So after the Great Depression, we come up with a different mortgage structure. So around 1934, we have a different mortgaging process. That kind of gets us to where we are today. Mortgages are quite literally a loan product that is created for you, and it's capitalized against your property that you're going to buy, meaning there's a lien. That lien says that whoever loans you the money has right to that property if you, the borrower, default. That's it. Now those liens, those mortgages are kind of wrapped up and they're invested in a secondary market. If you've got a retirement, 401k, a pension, if you're starting to do any kind of investing like that, chances are some of your money is actually tied up in a mortgage-backed security, something that is depending on Americans paying their bills regularly. This is actually pretty safe. The highest number of loans that don't go into default is actually a mortgage. So as long as the mortgage industry is kind of pumping out new loans and they're safe, they're qualified, they are built on ability to repay payments, you're golden. So you want to get a house and you don't know where to start. And so we're going to dive into how to actually prepare for the initial conversation with a loan officer like me when you make that phone call, or you're working with Realpha and they say, hey, time to get pre-approved at Be My Neighbor Mortgage, and you call in. Here's what we want to do. The first thing is get to know you. So let's just play this out. You call me and I'm like, hey, this is Nathan. How can I help you? Now, normally what I get is we want to buy a house. Perfect starting statement. That's why I'm here and what I'm going to help you with. Here's what I'm going to ask you to follow up on. What do you know? How much information have you gathered? Why do you want to buy a house? What are you prepared for to buy a house? What I'm looking for is your story. Who you are as a consumer is more important to me than what you want to buy at this point. Because I need to understand what you're going to get into. Some people are buying a home because it's time to invest in themselves. Some people, they had a house and they want a bigger house because their family's growing and they're going to talk about their kids, or they want a farm, they want more dogs in the yard. I mean, we all have different dreams and desires, And so they're looking for that property. Some have actually grown their family and they're looking to downsize, right? We talk about empty nesters and they're looking for maybe something smaller, something in a different community. We all have a reason to want to pursue this dream of home ownership or change in home ownership. It's my job, it's our job as loan originators licensed duly under the NMLS to help you, to facilitate that conversation. So share with us your dream, your story. Here's why you want to be in the home ownership. It could be, I want to make a lot of money in real estate. Perfectly understandable. It could be, I want to buy a house and live there and die there. Perfectly understandable. I want to have something to be proud of and show off, or I want to do it before my parents did it, or we're expecting our first or third or 15th child. We hear them all, and I love them all, because it's about you. It's what your dream and desire is. We want to help you fulfill that. Then we're going to talk about what do you not know specifically about the mortgage process. And that's where we get a litany of different questions coming back to us. They could be questions as simple as, how is interest payment calculated? How do we determine how much I can afford to borrow? How can my rent turn into my mortgage? Different questions like that. And so they're going to take different perspectives. Let me start with kind of the general ones. The next question, once you ask you kind of follow-ups and we get to know you and what your desires are, why you're doing this, I'm going to start asking about income. One of the greatest first steps is not credit, it's actually income.
So how much are we talking here?
So the big questions are, what kind of job do you have? Is it an hourly job? Do you get paid every week, every other week? Is it salaried? Does it matter how much you work, you get paid the same amount? How long have you had that job? And here's why. We are looking for historical data that helps us really believe that future will be the same. So you'll hear, if you don't have a job for 2 years before you apply, you can't get a mortgage. There's some truth to that, but not a lot. We're looking for history. You could be moving between jobs. You could have had a job, I'm throwing out there, driving buses because you're in college and that was a really flexible time, it fit your schedule. And then you're done, or you find a better full-time job or a different job and you move to that. What we're looking for is not necessarily it's all in the same field of work, but that every transition you're making makes some logical sense. It helps provide more for you. It fulfills your future desire and dreams. If you were going to college and then got a job in the same field, we love that. We can actually use college time as job credit into your future. It's easy. But a lot of times people are maybe a little bit embarrassed about how many jobs they've had or how many jumps they've done. Now, truly, if you're changing jobs every 4 to 6 months, it's a flag. It's a flag we need to overcome. We need to do what's called a letter of explanation. We need to look at why that reasoning was happening. Now, it could be out of your control. It could have been you found better jobs. It could have been, I used to work for Starbucks, and I worked for Starbucks for a long time, but before that I worked for a lot of restaurants. Frankly, restaurant work was who would give me more hours, allow me to wait more tables, and earn more tips. I mean, you jumped around a lot in the restaurant industry. Once I got to Starbucks, I found a passion to kind of keep doing what I was doing and build my way up, and I stayed there for 6 years. But after that, jobs come and go. They move. They're somewhat fluid. It's okay. We just want to understand the contract field or the temporary job stuff like an Uber driver, Lyft, piecemeal, seasonal. There can be follow-up questions to that. A lot of times if you work in a job where you're doing what's called independent contract work or you're a 1099, you are getting paid, either you've set up an LLC or you're a sole proprietor and you use your social security number, and you're getting paid for the work you do under contract or the number of miles you drive, like in trucking, right? We have to look at a different history. We're gonna actually look at the history, but then we have to look at the taxes. When you're in a normal job like a W-2 or a salary job, you get paycheck stubs, you get W-2s. What that does is allow to give us the history of your pay over time, plus your current pay and what we can extrapolate and calculate forward expected pay. When you're self-employed or 1099 or per mile or per trip, now that's a little different because that's not guaranteed work, what we consider like a W-2 or salary or hourly. And so what we're looking there is 2 years history of tax returns. We want to see how you calculate the income, how you're reporting the income. This gets some people caught off guard because if you're self-employed, a lot of times you want to retain as much of your earnings as possible and pay as little tax to the government as you can. I get it. That's actually not a bad thing to do. There are legal and right ways to do it. But this is one area that it may come back and nip you in the bud a little bit, right? You're like, it's going to hurt just a touch because if you're writing off a lot of your income, we can't use it to qualify. That's going to be a little difficult. There are ways to work through that, but we won't know until we dive in together. Let's say there's more than one of you that are going to finance the house. You and a spouse, a significant other, a co-borrower, a best friend. It's okay. A lot of loan programs allow for lending to more than one party if not married. It's totally fine. All of them do, actually. I shouldn't say a lot. All of them do. What we have to do then is just clarify who's paying what and get everybody's income together and really build that up. Here's why. Income is the premium and premier part of what's called a debt to income ratio calculation. Those debt to income ratio calculations take into consideration two things. The first part of it, it's usually presented in two numbers. It'll be like 35/49. What does that mean? Well, what we're looking for is that your home payment that you're qualifying for or applying for, the principal, the interest, the taxes, and the insurance on the property, plus, if it applies, the HOA or any other kind of extra monthly fee for that property, that is divided by your gross monthly income, and that gives us a percentage. Let's say you had $1,500 in principal and interest payments, and your gross monthly income was $3,000. Well, that percentage would be 50%, because $1,500 is 50% of $3,000. That'd be too high for a front-end debt-to-income ratio. We're looking for a sweet spot. We're looking for a sweet spot around 35%. Now, it's not a hard number. Can you go up? Can you go lower? Yes, there can be conditions and reasons why your DTI front end would be higher or lower. And we can usually find loan programs for those. Now here's the other part of the calculation. I said there were two numbers, right? 35%, we're looking for around that number in the front, and no more than 47% on the back. The back end DTI is the accumulative of your principal, interest, taxes, and insurance plus other fees for your home mortgage application, and the minimum reported debt load on your credit report. Now we get to credit. We're not even talking about scores. We're talking about how much you owe on your bills every single month. So if you've got a couple credit cards and they're pretty low payments, like 20, 30 bucks a month because you don't carry a large balance, and a car loan of $500 a month, well, you're going to take $550 plus the $1,500 a month for the mortgage payment divided by your gross monthly income. That gives us the back end debt to income ratio. Here's the beautiful part of that calculation. What it's doing is telling the lender that at the end of the month, if all things remain the same, your income remains the same and the payment's always the same because you got a fixed rate mortgage. We'll get more into that later in a couple more videos. At the end of the month, you will have no less than, say, 50% of your gross income still to use towards food, entertainment, utility bills, childcare, you name it, right? The cost of actually living in the United States, paying all the things you have to pay. That's a really important thing to do because that actually helps us understand the ability to repay ATR calculation. This calculation is a big part of qualifying for the actual mortgage. Now that we took your income and we kind of calculated in a debt to income ratio, we want to look at the credit. Now this kind of works similarly, right, around the same time, but now it's actually time to validate the credit. When we pull a credit report, we want to ensure more than just a score. We want to ensure that the credit lines are in good standing. How many types of credit lines do you have? Are they all closed-ended lines, like you borrowed on a car? When you borrow on a car loan, that is just one loan. You have a payoff period over time and you're done. You can't add more debt to that car loan usually. Credit cards are open-ended credit, right? You can use it, pay it off, use it, pay it off, use it, pay it down. You know what I mean? Like it just keeps moving and facilitating itself here. Student loans are also a different type of credit loan. And so those all impact your score. Debt utilization or credit utilization is the point that we're looking at. That affects your score. But we also want to know what the minimum payments are on every single credit line that's currently active and open. A credit report is a snap right now, or right now, or right now. It doesn't tell us all we need to know about you 30 days a month or 365 days a year, but it does give us a sense of how you utilize your credit in your everyday life. Now this is important because then a score is associated with that. Look, I'm not a big fan of scores this way because I think they can be gamified, I think they can be modified, I think the system uses them differently sometimes. But it's the world with which we work. And so we're gonna look at that score. Now, if you have a score below 620, that's gonna change some of our loan options. If you've got a score at 520, we may not be able to help you or below. But some loan products we can. But what we can do is at this point, we understand what you're making on a gross income level, and we understand what you're expecting to purchase or what you want to qualify for. And now we have a credit. And so as a coach, a consultant, a loan originator, I'm gonna walk you through what needs to happen. If you're good to go, we're gonna keep moving forward. If maybe there's a pause here, we're gonna have a dialogue, very personal. Here's your credit report. Here's what I'm seeing that could be a problem for us. Here's how we might be approaching that to fix it. I've worked with numerous borrowers who came in, they were not ready per their credit report. They had great income, they just had some dings. And we had to spend a little bit of time cleaning it up. And then we got them pre-qualified and ready to go. It's not a killer, but it may be a pause. It may be a moment where we just need to hold on, let's figure this out before we try to move forward. So after we realize the credit and we realize the income and we do the calculations of the debt to income, now we're gonna dive into the assets. What kind of assets are you bringing forward into this loan application? Assets are retirement accounts, cash assets, stocks, bonds, savings, checking accounts. If it's something you could liquidate, it might be something that you can use. So every loan, and we will get into this much more detail in some other videos, but every loan has closing costs and somebody has to pay those closing costs. Now, when you work with Realpha, you're actually going to have roughly upwards of like 3% that they can gift you for the buyer broker agreement to help pay those closing costs. So that's an added benefit. But if you're working with a standard realtor, you might need to hold off and understand how are you going to pay those closing costs. And we'll get into that, like I said, in another video. But where are the cash assets coming from? If you've got an FHA loan, you have to put a minimum down of 3.5%. A VA loan, if you qualify for service and you have a certificate of eligibility, that's 100% financing, no money down. Still have closing costs. USDA, you're trying to live somewhere outside of a major metropolitan area and you qualify with income, 100% financing, still have closing costs. A conventional 3% down, 5% down, 10%, it doesn't matter, there's a lot of options, but still have closing costs. So where's the cash coming from for the down payment and how are we gonna pay those closing costs?
Show me the money.
So we wanna get that clarified in all the assets. Now that's our general conversation. When we are done in this initial conversation and you are ready to move forward, and we've sketched out some notes on this, I'm gonna make sure that you then have an application form. You're gonna set up an account with us. And this account allows you to upload and move information to us securely. It's double impact, multi-factor authentication. We don't want you emailing your private documents. We need to do it very securely here. We're gonna work that application, which is called a 1003 or an URLA, Uniform Residential Loan Application. And we're gonna get you kicked out a pre-approval letter. Okay, there's usually more questions in all of this at this point. We start working in the process and we're gonna have some follow-ups for you. Maybe you submit some documentation like your photo ID and guess what, it's expired. Well, we gotta get that fixed. We can't move forward with an expired photo ID, but we'll help you with that. Maybe your payroll and our verification of employment, that's not coming out or doesn't look the same. We can work on that, that's not a problem. But we're gonna work your file up and then we're gonna have another conversation. How do you feel? This is so important to me. How you feel about your opportunity to buy a home during this initial process of trying to get you pre-qualified for a mortgage is extremely important. I have unfortunately had opportunity where couples have sat in front of me or on the phone or video screens, and they weren't in lockstep. And by the time we got to this point, I'm watching them fight and argue. That's a red flag for me. It's like something's not quite right. We need to work on how you feel about the process. Are you confident that we want to move forward? Are you still scared, but you're willing to trust and keep stepping forward? Are you like, whoa, hold on, this is going to be too much. I just need to back off. The one thing you never want in a mortgage opportunity with a loan officer is to feel forced. I think you need to remember something, and you may not even be aware of this. Thanks to the SAFE Act, you borrowers, I am included in that because I've got a mortgage on my property, are actually in more control than ever before. It's on you to understand what your rights and responsibilities are, but it's on me, the licensed professional, to give you that information. Thankfully, we've got a lot of great resources. Resources like the CFPB, resources like HUD and FHFA. They've got a lot of buyer resources to help explain what you're looking at. Now, if we've built up some trust and you understand what we're doing, I will try to answer every question for you. And I've even answered the questions like, I don't think this is the right time. I don't think I should be the one doing your loan for you. I think it's time to maybe look and just wait. If you don't like that answer, you can go elsewhere. It's okay. That's on you. That's your power. The power of choice is so important to hold on to in the mortgage transaction. This loan. There are roughly 18 different organizational steps that go into this that have nothing to do with your mortgage broker or the lender or the realtor. We've got title and escrow. We've got insurance. You've got an appraiser, an inspector. You possibly have a land survey, depending on what state you're in. You've got your credit reports. You've got the recording deeds to the county or the borough, depending on where you're buying. Then you've got some prepaids, and those go to the state taxes and your prepaid insurance. You kind of can see how you encapsulate all of that. There's a lot of money that has to be put together to make this transaction work for the transaction of the purchase. Now, we can't say all the fees will be paid out of the loan, not in a purchase. In a refi, yes, we can do that. But in a purchase, somebody has to pay for them. There's 3 ways to pay for your closing costs in a purchase transaction. The first is you have the assets, the cash, the liquid cash to just say, hey, I see it's gonna be $12,000. Here's my $12,000 when we close, let's go. And you're gonna put some of that down on the purchase called earnest money, and then it gets applied to your closing costs and you're all set. The other way, second way, is what's called a lender credit. Now, the lender has a certain, so as a broker, we connect you. I mean, I'm gonna shop 35 different lenders for you to make sure we find the one that has the best interest rates and terms and everything you want that matches your dream and gets you to the final stage to really fulfill that dream. The lenders, based on the market, now this is where it gets secondary market stuff, gets a little sketchy, but like interest rates, they go up and down, right? It's because the secondary market is buying loans at certain interest rates with certain premiums. And those premiums then are how the lender makes their money. The lender, if it matches its premium level, it will actually give you whatever is over that. That's called a lender credit. So let's say the interest rate was floating out there at 6.5% at what we call par. It didn't cost you a discount point to get it, but it also didn't give you any credit when you got it. It's 0. Everybody's happy, 6.5%. Now, you could actually get credit towards your closing costs if you went to, say, 7%. Maybe 7% would give you $3,000 in closing credit. Now, the lender's going to credit that to your closing disclosure and your final bill. Now, you're going to pay it over time, right? How do you pay it? Well, you pay it because of the difference in the principal and interest payment between 6.5% and 7%. You're effectively financing that closing cost. It's a tool. It's legit. You can totally do it. The third way is this. It's called seller concessions, sometimes called seller credits. You can negotiate with a seller to buy a house. Let's say we're going to buy a house at $200,000 and you ask that seller, hey, we want you to chip in 3% of the purchase price for our closing costs, which would be $6,000. And the seller can say, awesome. It saves them from maybe reducing the price to sell a home faster. They go, okay, $200,000. As long as it appraises, we'll give you the $6,000 at closing. Money never changes hands between you and them. Instead, the escrow balances that and says, okay, seller, you're selling the house for $200,000. We paid off your current mortgage. That means there's X amount of dollars left over. Subtract the $6,000, that goes to the buyer, and you get this. That's how it works. And on your closing, it's like, well, you owe us this much money. The seller credited you $6,000. Here it is. Boom, we're all done. It's very simple. Or the other way this can happen is working with an agency like Realpha. They can go to your benefit and to facilitate this for you in the negotiations, ask the seller to consider maybe a little bit more. Maybe they say, hey, seller, we'll offer you $203,000, but we'd like 9% or 6%. And however that negotiation happens, you are still financing some of those closing costs, because effectively you could get the house for less money, but pay all the closing costs out of pocket. But if you actually ask the seller to pay for it, well, it's just in your loan, it's all wrapped up, and it really doesn't change your payment very much. Sometime do a calculation like this. Take 6.5% paid over 30 years on a mortgage balance or a loan balance of $200,000. Check out what your principal and interest payment would be. Now, add $6,000 to $200,000, so make it $206,000. What is your principal and interest payment there? It's really a pretty effective way to help pay for your closing costs in a market where those sellers will negotiate that. And frankly, in today's market, almost every seller is going to negotiate that. I hope this time actually helped you kind of get more comfortable with what it's like to have a conversation with myself, a loan officer. And if you have other questions, I'd love to see them below in the videos. I'd love for you to reach out to us anytime at BeMyNeighbor.mortgage. We're here to help. We're here to actually facilitate your success, fulfilling your dreams of home ownership. Whether it's the first, second, fifth, 10th, I don't know, bare land, commercial property, whatever it is, we can help you out. Just know this, when you want to fulfill a dream of home ownership, real estate investment, buying something that maybe you thought was out of reach, you need to have somebody on your side who helps teach you what the next step is. You need to have somebody on your side to help you find that, like Realpha. Between Realpha and Be My Neighbor Mortgage, you've got a pretty powerful team in your corner, and we can help make you very successful. My name is Nathan Nottingham with Be My Neighbor Mortgage, and I'm excited to talk to you soon. Take care.